technical analysis. That's a long trend. So that's from 2006. So that's what we can see. Okay, and that's what is biggest point, 150. And we saw why, because the growth was quite high. And actually, wait a second, we didn't go through PE. I just return for a second. You see PE in 2030 here, it moved to nearly 20. Okay, so at the lowest point, it was around 10, 14, 11, 11, 11, and nearly 19. So we can say that the PE like ranges between 10 and 20, and at the moment it's 10, so it's a low point. Okay, so we can see that it's normal for company move from 10 to 20. Okay, so that's why I wanted to show this before I show the graph. So here it was 20 P. So basically, if it was 10, the price would be half of it. So it would be from 147 divided by half, 70. So that's exactly where it is. Earnings didn't drop. Earnings are exactly the same, even higher, but the price halved. Okay, so that's what's happening. Now we can see technically 1, 2, 3, okay, and based on these technicals, so it might go even further. Now, why I put this line here? Because in 2013, it kind of holded this position for like half a year about this level. Okay, and now it's kind of slowed down on this level, and it's already hovering it for a month. Now, if it breaks through this level, it might go to the previous strong previous resistance, but it might become a support. So it's around $51 level if it breaks technically on that. Now we have to be ready for that, because I mean, majority of people on the stock market, a lot of people on the stock market, they trade emotions. They don't trade fundamentals, and you might think, oh my goodness, all these cases, all these problems, who knows what is going to happen, and bam, it goes down. So it's another $17 down. So $17 is what, about 20%, yeah, so more than 20%, 24% downside. So based on technical analysis, okay, that's what can happen. Now it might never happen, it might never go down, because it's already undervalued, it's already PE 9, yeah, so that's why it probably possible if the share price really start losing earnings on that particular share. Now this is the same trend, these two lines. The reason why also my personal opinion that it might slow down here is that, look what is happening here. It's still lower, each low is lower than previous, but the curve started occurring. So you see, it doesn't go all the way to this trend. So there is another trend. So it's like a triangle form. And also I can see that these points are higher. So it's kind of a growth here. So for me, it's important point to see. Okay, so that's what at the moment, and its trend is narrowing down. And end of triangle, if it breaks through this trend, so it might start the new trend. But even if it is in this trend, from $67 to $81, it's quite a lot of room to make money. So at the moment, if we look at technicals, it's really unclear, because stochastic is in the middle, RSI is in the middle, MACD is moving up. Only MACD is showing us that it's going to go up. Okay, the rest of them, they might reverse and move down. MACD can do as well. Now, at the moment also, it's a first wave, and we cannot tell what is happening right now, so we cannot create new trend. The only thing we can rely on the trend which is bigger, okay, so which lasts from August 2016. We can expect that it can go somewhere here or can stay on that level. It's a long support level, or it can go to $81. So that's at the moment options which we see, and we can see that there was a gap after this publicity in multimedia, and then it's closed this gap in 2 weeks time after earnings. Earnings would They showed better than expected earnings, but after that it slowed down. And the reason why it's dropped down, this one. Remember last quarter I was telling, well, last month I was telling you about retail ETF, XRT. It includes retail companies from S&P 500. So that's what we see. 1 roll, 2 roll, 3 roll. Last masterclass we had, it was somewhere here. And based on this kind of habit, you see, it fell down, had small roll, then moved up. Fell down, had small roll, moved up. Okay, didn't have anything here. So I thought, okay, it might move like here up, or might have another small roll here. And that's what happened here. So we have this small roll. So most likely, like if it's repeats similar type of pattern as before, it might go back up. And that's the retail industry. So that's why a lot of retailers now undervalued. Okay, they're below the price. Now the only question I have is why every company on the stock market after President Trump was elected moved up in retail industry instead of that. Like it's moved up, but after that it's collapsed and went down. What's the reason for that? Why do you think so, guys? And it's related to the question which I asked you earlier in the masterclass. Why do you think retailers now in this type of zone, in the pessimistic zone, let's say? A lot of businesses, they believe that Donald Trump will do well for them, but not retailers. Why? Back. You won't correct that. Because majority of retailers, do you remember I asked you where do they manufacture their products? China. And if you heard Donald Trump, he kind of a lot talking about imposing import taxes extra for Chinese products, and he wants to bring all these manufacturers back to United States. It means that their prices will have to go up, so they will become less competitive. Okay, but from my opinion, if it happens, yes, it will. The prices will go up, but at the same time, all prices will go up. It's not only one particular retailer will lose the advantage; it's all of them will lose it. So in this case, it's kind of, I think it's pretty all right in my case. So, but if this trend will continue up, it can go to about $49 level, $48 level, so from $41 level, so it's about 20% upside down, or about $8, so it's about on a $40 ETF, so it's about 20% possible upside potential. Okay, and when the stock moves here, so I presume all stocks which included in retail, they're going to move up. Okay, that's why Signet, which is here, 20%, it's what, about $15, $15 from 67, that's about $82, so it's somewhere here. So if it follows the ETF trend, I mean the S&P 500, whatever included there. So that's why I can see it's here, or I can see it somewhere here. Now, if you decide to buy it, like if you decide to buy it, similar to course, where would you do it? What level would you enter this position personally? Or would you enter it at all? Maybe you won't. Okay, 165. Okay, 63. All right, 65, 63. Everyone else is quiet. Okay, let's have a look what I have here. Okay, 66. So if you do a long-term investment, I would be, based on what the market is down high and might have a pullback, so it's quite possible that it might go to $62, $65. So if you buy for long term, yes, you might set the limit order and enter at these levels, and then hold it until 96 to 125. Now, where these numbers came from, it's again fundamental analysis. If you go to 96, it would be our highest buying point, and 125, it would be our highest holding point. Okay, and if you do this, if you hold it and you buy it at this level, so it will give you about 100% profit, capital growth plus dividends. Now, if you're a value trader, you buy at 65 and sell at 72, 75, 81 dollars, which we looked at this. Okay, so that will give you roughly 15 to 20% profit on a trade, and it might take 1.5 to 2 months here. Okay, based on the roles which they have. Okay, that's if you're a trader, if you're more active. Now, if you use option strategies, similar thing. I made a screenshot until April 21st of April. The thing is here that the price is now 67.50, so it's between 70 and 65. So there is no at the money strike price. So it's out the money, in the money, and that's why you can choose. So only two options what to do. So if you're playing aggressive, so you believe the share price is going to move up, you might choose $70 strike price. If you're more conservative and you want to play safe, you can go for $65 strike price. Now, if you do that, so let's have a look at that. If you do conservative and you use $65 strike price, so it means you promise somebody to sell your shares $2.5 below the current price, but you get $4 for that. So clear straight away income $1.5. Now, if the share price is exercised, yeah, $1.50 would give you 2.16% profit, and you're quite conservative because your average price, if the share price eventually goes down, like I mean, if it goes below $65, and you have to, if you still keep it, your break-even price or cost of the shares will be $63.51. So when you take 65 minus $4, oh no, 67.50 minus $4. That's what you are going to get. 1 cent probably it's commission here included. All right. Now, and it will give you 25% annual profit if it's exercised, and 70% profit if not exercised. Okay, cash profit. But you remember here you will have a capital loss on the top of them. Here you'll be back in cash because shares will be taken from you in the end of month at the price of 65. So you bought 67, sold at 65, and got $4. So you lost $2.5 on the sale, but you received $4 on the rent. Now, if you're aggressive, what you do, you agree to sell it only at $70, higher than the price. You got 150 straight away. So it will give you 2.2% if the share price didn't go above $70, but it will give you 5.8% profit if the share price moves above. Because in addition to $1.50 which you received from rent, you also get $2.50 capital growth and on the sales because you bought 67.50 and sold at 70. So that would be your profit. And again, it will give you 70% profit if exercised, and if you keep doing similar deals every month, or it will give you 26% if it's not exercised. So you see, guys, it's like equal. So if you're right, you get 70%. If you're not right, you get 25%. So it's still quite good, but it's much better to be right because in this case, your profitability like 3 times nearly more than anything. Okay, so that's buy strategy, rent one. Now, if you decide to sell naked puts, again, I want to repeat that you do sell naked puts only when you are happy to have the shares. And again, conservative and aggressive option. Conservative, if you decide, okay, I want to buy shares only at 65, and you promise somebody that you buy shares at 65, right? But they're going to give you right now $1.55. So even if you decide eventually have to buy the shares at 65, the real cost of your shares would be 65 minus $1.50, which is $63.45. Okay, which is much lower than the prices which you wrote here. Peter wrote 63, so it would be just 45 cents above it. Okay, now, and if the share price never goes below $65, your profit would be 2.4%. Okay, and annual profitability, it will give you 28% annually. Now, if you're going to play aggressively and you believe the share is going to move up, so you sell $70 put, you can get 3.9. Okay, that's the prices here, 3.9. Okay, and here it's 155. You can see it. okay, for 65 cents. Actually, last night I personally sold, I got $4.05, so it's more than even that. And in this case, your profit would be 5.5% if the share price moves above $70. But if it doesn't move above $70 and you have to buy it at $70, your buying price would be $66.10, which is $1.40 below current price, which is still quite good, right? So because you're buying much cheaper, so you're buying kind of with a discount. All right, guys, is everything clear about this two strategy?